Hello listeners, good evening to all. I am Dr. D.V. Singh, Senior Assistant Professor, Department of Commerce, the BHOPAL School of Social Sciences. Today I am here to discuss on a very important topic, that is dissolution of partnership firms. As we know that the dissolution of partnership basically means winding up of the business activity of any firm. Dissolution of any firm or business is the process of winding up of business when the relationship between partners dissolve or terminates. As per the Partnership Act of 1932, the dissolution of the firm is the dissolution of partnership between all the partners of a firm. The dissolution of the firm differs from the dissolution of a partnership, as the dissolution of a partnership just involves the change of relations of partners of a firm, whereas the dissolution of the firm is the complete winding up of the business. There are different types of reasons for dissolution, such as dissolution by the court, dissolution by agreement, dissolution by notice, and compulsory dissolution. The firm needs to sell all its assets, settle the accounts and liabilities, and discharge all the claims before the dissolution of the firm. Now, what are the important reasons of dissolution of a firm? The firm or company dissolution shall occur due to the following given reasons. It may be if there is a change in the profit sharing ratio of the existing partners of the firm. Second, if there is an admission of new partner in the firm. Third, if an existing partner retires. Fourth, in case of expulsion or death of an existing partner. Fifth, in case of expiry of a partnership period. And the last, if there is any insolvency of a partner. So these are the some important reasons for dissolution of a firm. Now, mode of dissolution of a firm. The mode of a dissolution may be divided into two parts. First one is without the intervention of the court. The ways for dissolution of a firm based on mutual decisions and without the court's interventions are: number one, dissolution by agreement. So what is exactly dissolution by agreement? The dissolution by agreement involves the approval of all of its partners. It is stated that a firm is made by the agreement of all its partners. Similarly, a firm can be dissolved by agreement and approval of all its partners. Then second, compulsory dissolution. Compulsory dissolution involves two main reasons. The first one shall be when all or one of its members become insolvent and are now incapable of any agreement. The other reason is when the firm becomes unlawful due to any reason. Then the third one, dissolution by notice. Dissolution by notice involves firms that is not on the duration of the partnership. In such firms, any partner can dissolve the firm by giving notice to other partner of the firm for its dissolution. The next one is dissolution due to a certain event. Besides the above reasons, there are certain reasons or due to just occurrence of certain events. There are three more reasons for the dissolution of a firm. These are: on the completion of the reason the firm was established. Second, due to insolvency of any partner. Third, the expiration of the period of the formation. Second one is with the intervention of the court. The dissolution of the court can be due to an application filed by a partner of the firm to the court. The reason for the dissolution by the court are as follows. Number one, when one of the partner of the firm becomes unsound mind, that means mentally unstable for handling the firm. Second, when any of the partner other than filing a case has become incapable of fulfilling his duties and responsibilities towards the firm. Third, when any partner other than filing a case willfully breaks any law that can harm the partnership. Next, when any partner other than filing a case transfer all its interest to the third party or closed one. Then next, if the court thinks that the firm is incapable of producing any profits in the future and will only carry the loss. So these are the some reasons when the court will intervene to dissolve any firm. Now, once the firm is dissolved, how the accounts of the firm can be settled? Under Section 48 of the Partnership Act clearly specifies the modes of settlement of accounts after the dissolution of the firm. These are as follows. Number one, the amount of loss, including the deficiency of capital, must be paid out of profits or out of capital. Second, if required, it needs to be cleared off by the partners' profit sharing ratio. Third, after the dissolution, the amounts of the sale of assets of the firm shall be used in 4 different ways. Number one, to clear all of the outside debts of the firm. Number two, to pay the loan advances of the partners. Third, to return balance capital accounts. And lastly, if the amount remains, to divide it among the partners according to profit sharing ratio. Now next, accounts procedure on dissolution of firm. For the complete dissolution of the firm, 4 accounts in the given order are opened by the firm. The first account name realization account. Second one is partners capital account. Third, partners loan account. And fourth, cash or bank account. Now here are the format of realization account. As realization account basically prepared at the time of dissolution to know the profit or loss on realization. Generally, all the assets, realizable assets except cash and bank balance are debited in realization account. For example, to land and building, to plant and machinery, to furniture, to bills payable, to sundry debtors, and then outside debt of the firm or liabilities must be credited in realization account by sundry creditors, by bills payable, by bank, by outstanding expenses, by provision for doubtful debts. Once assets and liabilities of the firm is debited as well as credited in realization account, then we have to see what are the amount realized from these assets by sale into the open market. That realized value is just mentioned in opposite side. Realized value from asset is just mentioned in credit side of realization account under the head cash and bank. Same way as liabilities of outside debt of the firm is just mentioned into the credit side of realization account. If all liabilities were paid off, that will be mentioned in opposite, means debit side of realization account under the head to cash. Then finally, the cost of realization is also debited in realization account, and at the end realization account is closed to find out whether there is a loss or profit. If the credit side of the realization account is higher than the debit side of the realization account, balance is known as profit on realization, and the profit on realization will be shared among the partners according to their profit sharing ratio. Same way, if debit side of realization account is higher than the credit side, the balance is called loss on realization, and this loss is transferred to the partner's capital account as per their profit sharing ratio. Now the steps for realization, which I have already explained, but step 1, transfer each of the assets excluding cash balance and fictitious asset on debit side of realization account. Step 2, transfer all the outside liabilities of the firm on credit side of realization account. Then step 3, amount realized from depositing of assets or disposing of assets is shown on credit as at, this is income, an income, that's why shown into income side or credit side of realization account. Under step 4, payment made for clearing of all outside debt or liabilities of the firm is debited to realization account as it is an expense. Step 5, showing the payment of realization expenses on debit side. And under step 6, disposal of all unrecorded asset is shown on credit side of realization account. Step 7, payment of unrecorded liabilities is debited to realization account. And step 8, reserves like depreciation reserve, investment fluctuation reserve, joint life policy reserve are credited to realization account in case if assets corresponding to all these reserves appears on the asset side of balance sheet. Step 9, now at last the realization account is closed. Excess of credit side over the debit side of the account shows profit, which is credited to capital account of partners as per their profit sharing ratio. Whereas in case if debit side exceeds the credit side, then it represents the loss, and this loss amount is debited to the partners' capital accounts. Now, specimen of capital account. After preparation of realization account, capital account of the partners are prepared. The purpose and objective of preparing partners' capital account to know how much amount supposed to be paid off to the partners from the firm, and also to know if needed how much amount supposed to be bring into the firm by the partner. Each partner's capital account is credited by the following. Number 1, credit balance of his capital, his share of general reserve or undivided profit, his share of realization profit, amount of any liability which has to pay, credit balance of his current account if any. Then there are certain items which needs to be debited in capital account of the partner. Each partner's capital account is debited by the following. Number 1, his drawings and interest on drawing, his share of realization loss, amount of any assets taken over by him, debit balance of his current account if any. Finally, after closing the partner's capital account, whatever the balance comes, whether it's a debit or credit balance, it will be shown under the head cash. Whether if it is a credit balance, then to cash account. If it is a credit balance, debit balance, then it is by cash account. Balance of capital is transferred to cash or bank account. If capital account has debit balance, it will be brought in cash by partners if he is not insolvent. Now, loan account of a partner. If a partner has given a loan or advances to the firm, then a loan account is prepared, and this account is closed by transferring in cash or bank balances. Now finally, to wind up the entire business of the firm after dissolution, the bank or cash account is prepared. The basic purpose or objective of preparing bank or cash account to settle down and to close down the entire liability of the firm. This bank account is debited with the following items. First, number 1, balance of cash or bank as per balance sheet. Number 2, sale proceeds of assets. Number 3, any such amount which have been brought by the partner in order to make up the deficiency of his capital. And then account of bank account is credited with the following: payment of creditors and other liabilities, payment of dissolution expenses, payment of partner's loan, then payment of credit balance of partner's capital accounts. Now here are the some important journal entries regarding to the transaction happened or at the time of dissolution of the firm. As I told you, at the time of dissolution, all the assets and were sold out and liabilities were paid off. That's why related to realization account, related to realization transaction is made, and profit on realization or loss on realization is calculated. So first of all, as I told you while discussing about realization account, as all the realizable assets are debited in realization account, so first entry would be realization account debit to sundry assets account. Then all liabilities account debit to realization account, provision for bad debt account, provision for depreciation account, specific reserve and funds account debit to realization account. Then bank account debit to realization account. This entry is passed for realizing money by sale of assets. Then next one is partners account, partners capital account debit to realization account. This entry is for when any partners have purchased a particular assets, then his account is debited and realization account is credited. Then to record the outside liabilities, creditors, outstanding expenses, next entry will be made, that is sundry liabilities account debit to realization account. Then to pay the liabilities or realization expenses, the entry will be, first one is realization account debit to bank account, then realization account debit to bank account. And if some personal loan partners loans and advances were paid either on discount or premium, then entry would be partners loan account debit to cash account to realization account if paid on discount. If the partner's loan is paid on premium, then partner's loan account debit, realization account debit if paid on premium to cash account. Then finally, if there is a profit on realization, then realization account debit to partner's capital account, and if there is a loss on realization, then partner's capital account debit to realization account. So these are the journal entries generally made in case of dissolution of a partnership firm. At last, I would like to conclude the entire lecture. Dissolution of a firm is the complete winding up of the business of that firm. It differs from the dissolution of the partnership, which suggests that the relationship between the partners changes rather than the dissolution of the complete firm. The dissolution involves selling all the assets of the firm, clearing of all the liabilities and accounts, and discharging all the claims. There are different reasons for dissolution. such as dissolution by the court, dissolution by agreement, dissolution by notice, and compulsory dissolution. Thank you. Thank you for listening sincerely. And this is the end of this module 1, Dissolution of Partnership Firm 1. Very soon I will be again joining you with Dissolution of Partnership Firm 2, that is Garner versus Murray rule. Thank you.